Professor Siegel, not mincing many words there. What do you think about his take when it comes to the Fed taking these rate hikes too far?
I agree with him. I think that we are underestimating how much tightening is happening in the banking system because of what happened with SVB and because of how many deposits have left the banking system generally. And so there is that, and you are starting to see some real disconnects in the market. The way that the high yield market is not consistent with the equity markets. And I'm going to side with the bond markets on this. I think that we are probably more in troubled waters than flying free and clear. If you look at what is happening, what's being priced into the Fed fund futures, that likelihood that there's one more rate hike and then eventually we have this nice cutting cycle. That's not really priced in to the yield curve. The yield curve is pricing in a really, really, really tough recession. And if you look at the way that that economists are forecasting the recession odds, they're actually raising the outlook for 2023, but they're worsening the outlook for 2024, suggesting that this recession is going to be longer than the usual recession. And we are already in an earnings recession. So corporate earnings right now are already starting to get hit.
Yeah, first quarter corporate earnings expected to decline just about 7%. So I want to get into what these other economists are saying. As you mentioned, a lot of economists are forecasting a recession. Now we have the Fed minutes saying their base case is a recession. How does that impact portfolio management on your end, specifically when it comes to short-term bonds and equities?
Look, I think that this is in the near term, you have to stay defensive. But the problem is that a lot of defensive is very expensive. So you have to look for places right now. We are getting back into a world where stock picking matters. The quality of earnings are going to matter going into 2020. End of 2023 and into 2024. And so we're staying, quite frankly, high quality. Within the credit space, we're staying as high quality as we can get, high up in the capital structure. We're not super bullish on earnings per se, because we know that we're going into a trough in earnings, and that's probably going to continue. So being higher in the capital structure isn't a bad idea, except that debt matters and balance sheets matter. So this isn't an easy walk in the park where you can make big allocations. This is a stock pickers and a bond pickers market.